The biggest StETH pool almost empty, complicating exit for would-be sellers. One of those would-be sellers would be 3 Arrows, as we know, has not been able to liquidate all their StETH. And that's causing one of their larger problems that they did not report on to the Wall Street Journal. A trading pool that large institutional investors such as Alameda Research and 3 Arrows Capital have used to dump their StETH tokens is now nearly drained and heavily imbalanced, potentially trapping retail investors as well as embattled crypto lender Celsius. As cryptocurrency markets swooned in the recent weeks, large institutional crypto investors, including Alameda and 3 Arrows Capital, have used the blockchain protocol Curve to dump their holdings of a token known as staked Ether. The urgency came because the price of staked Ether tokens unexpectedly deviated from a supposed peg to the price of Ethereum. What is that at now? So let's go to CoinMarketCap and just take a look, right, at how much this is depegging, because this is going to be important. We've been calling it since before it started to happen. We told you guys it was going to happen, and it's really important to keep track of. Ethereum is at 10,081 right now. Let's go ahead and take a look at StETH and see if it's down below 1,000. That would be pretty bad. It is not. It's actually up right now to 1,098, quite surprisingly. So this is kind of getting interesting. Is that because it hasn't dumped enough, or there's no liquid? So there's where the reversal happens, right? You end up having StETH temporarily more expensive because there's none of it in the liquidity pool. I believe last we checked 80%, or sorry, there is a bunch of it in the liquidity pool, but you can't get it out because there's no ETH in the liquidity pool. So the price of that just kind of sits there. This is kind of getting interesting, guys. All right, so that's where we're at. It's still depegged, but it's done a reversal right now, as of right now. Okay. So the bigger, better known native cryptocurrency of Ethereum blockchain, which is the second biggest overall after Bitcoin. Now, however, the so-called liquidity pool in Curve that the investors use to get rid of their StETH is quickly drying up, a dynamic that might force future sellers into less transparent over-the-counter markets where discounts might even be steeper. The pool in question on Curve lets investors exchange StETH to ETH. Since nearly May, its total value locked, which is TVL for short, a common way of measuring the size of these protocols in decentralized finance, dropped to 621 million from 4.6 billion, data shows. It is also heavily imbalanced. That was actually a sneeze. It is also heavily imbalanced, holding almost 5 times as many StETH as Ether, making it expensive or impossible to swap large amounts of tokens. Because basically what happens is you go in there, and this is the reason why 3 Arrows Capital didn't liquidate all their StETH, is they go in there, they add the liquidity, and it only allows them to basically swap so much. You can see this in any liquidity pool. Actually, I have a quick example for you guys on Ergo Dex, right? This is for a Neta, right? And then if we wanted to take Neta and actually swap it to SIG USD instead, which is the stable coin, you'll notice the $75 is not equal to the $58 here. But if we drop this down to $75 worth of Neta, then at that point, or to $58 worth of Neta, then we would actually make a full trade. This is a liquidity imbalance between Neta and SIG USD. However, if we go to a more popular token that has enough liquidity in it, you can see here that we have enough Neta, or we have enough liquidity between Neta and between Ergo to make our swap of $75. It's a lot easier to see on these smaller, newer startups for DeFi, especially on the Ergo blockchain. So I wanted to use that as an example so you understand. So if you come into one of these, right, and this is like Ethereum, or StETH in Ethereum, you would have basically StETH up here and then, you know, ETH down here, and you're trying to swap 75 million or whatever it is for 75 million ETH, but you only have 58 million ETH available to you. Now, it's actually even lower than that now at this point, as they talked about, because as you can see here, 621 million from 4.6 billion is quite a big drum, right? So I feel badly for retail holders because the Curve pool has been their only way out, Vance Spencer, co-founder of venture capital investment firm Frameworks, told CoinDesk in an interview. Institutions still can get their way out of this with the over-the-counter deals, although at a significant discount much higher than in the Curve pool. So that means that they go off-chain, they start making deals with someone that actually has some Ethereum, and starts dumping their staked Ethereum to outside holders, and at a very discounted price, right? And that means that, of course, you will end up driving the price of StETH down further once this finally hits, because there's no liquidity in the pools. The discount on StETH has been in an analyst spotlight as a telling sign of the recent liquidity crisis in crypto markets. One StETH represents an ETH token locked up on Ethereum's new blockchain called the Beacon Chain. During times of high inflation and aggressive rate hikes, investors prefer holding liquid assets that can easily be sold. The problem is that tokens locked up on the Beacon Chain cannot be redeemed in the foreseeable future until 6 to 12 months after Ethereum successfully completes a much anticipated upgrade to Proof of Stake network, often referred to as the merge. And based on the latest estimate from the top Ethereum officials, the merge isn't expected until August at the earliest, which we already know has been delayed till mid-September, but it's kind of up in there. They could do it earlier, of course, but mid-September is what they targeted via the EIP for the difficulty bomb 5144. Okay, so we're really looking at September at the earliest now, in my humble opinion, and maybe later, of course, according to people like Charles Hoskinson at Consensus 2022. Chase Devins, analyst at blockchain data platform Messari, wrote in a note earlier this week that StETH is in the early stages of its natural price discovery, and the discount will likely close when staked Ethereum is unlocked on Ethereum's Beacon Chain. When that staked Ethereum and it gets unlocked on the Beacon Chain, you will see a massive dump in the price of Ethereum overall. This is where the actual comparison between staked Ethereum as a wrapped token and Ethereum becomes extremely relevant. A lot of people are trying to say that the price of StETH does not affect the price of Ethereum, but they're completely inaccurate. It's just going to be a future projection of the price of Ethereum. And that is something that is going to be extremely important to pay attention to. The other problem with this is everybody's expecting the merge to happen so that they can unstake their Ethereum, when in fact, as we know, when we take a look at the roadmap from Tim Pico on his GitHub, it is very clear that there are no plans to unlock staked Ethereum for withdrawals post-merge. We know that will come in an EIP later with no announced date or time, or even an EIP written at this point. So that problem of the merge will unlock the staked Ethereum is a fallacy. This is another position where a lot of large news outlets are not reporting accurately, and it needs to get fixed. I wish someone would listen, because it's becoming extremely frustrating at this point. Until last month's implosion of Terra blockchain, StETH traded at a 1-to-1 ratio with Ether, but then a 2 to 3% gap of prices opened up. The gap further widened to 5 to 6% by early June in the wake of financial troubles of crypto lender Celsius and hedge fund Three Arrows Capital, both major holders of StETH. The transparency of the positions of Celsius and Three Arrows Capital had put those firms at a disadvantage, in the sense that short sellers knew how much to attack certain assets to try and cause liquidations. Lex Sokolin, head economist and global fintech co-head at Ethereum Developer Consensus, told CoinDesk in an email. Consequently, some of the larger holders dumped their StETH to get ETH, mostly using the Curve pool. Data by Kaiko showed that the StETH to ETH Curve pool was responsible for 98.5% of all decentralized exchange trading volumes in StETH in the last few months, while trading on centralized exchanges was negligible. Why would that be? Well, that's actually pretty easy to determine. The reason why centralized exchanges are not having it is because centralized exchanges, for the most part, have completely shut down swapping for this. So the only places to actually do the StETH trades, right, because they're actually able to back it, because there's some ETH there to actually support it, is going to be your DeFi like Curve, Uniswap, SushiSwap, etc. So that is why that's happening, right? The centralized exchanges do not have this ability because they don't have any way to get their ETH out of the stake that they've put it into. Amber, a crypto investment platform, pulled out $160 million within days in early June, according to the Kaiko report. Alameda Research, a digital asset trading firm, sold $88 million in StETH, and Three Arrows Capital, the hedge fund that faces a potential insolvency, redeemed about 400,000 ETH and StETH tokens from the protocol in May. The reason liquidity providers left is that once the peg broke, they got a terrible deal in that they were selling ETH too cheap, said Bob Baxley, Chief Technology Officer of automated market maker Maverick Protocol. As the pool became imbalanced, they did not want to get trapped only holding illiquid staked ETH. As a result, the Curve pool has lost 85% of its value and holds roughly 111,000 ETH and 492,000 StETH, an indication that many more investors want to sell StETH for ETH than the other way around. Celsius, a big crypto lender now under scrutiny since it halted withdrawals, citing extreme market conditions, might be trapped with its StETH holdings. Celsius still holds at least 409,000 StETH, worth about $413 million at current prices, according to data provided by 8board, a portfolio tracker from the blockchain analysis firm Nansen. The StETH Curve pool only has about 110,000 Ether, meaning there is simply not enough tokens to swap StETH into. So you see here, they have 409,000. But if we look at the liquidity pool like we were talking about, there is only 111,000 ETH to be traded. So in a liquidity pool, because it's DeFi, there has to be a staked amount equal to, of course, this amount. So somebody would have to come in here and add another, for them, right, to get rid of this, they would have to add another 300,000 or so StETH to liquidity. The problem is when you add liquidity like that, you're having an issue where you end up with kind of an imbalance as well. What would have to happen is the current liquidity providers would need to basically get out their staked ETH and then rebalance the liquidity pool, but then they're stuck with a whole bunch of staked ETH that they would have to swap themselves, and then at that point you end up with the imbalance once again. It's a problem for DeFi for sure. Celsius couldn't have sold all of their StETH on centralized or decentralized exchanges, and as a result likely had or will have to resort to an over-the-counter type transaction in an effort to remain solvent, Kaiko's writer wrote in a note. Average investors who want to get rid of StETH may have even fewer options since they typically cannot access over-the-counter markets to strike a deal. Centralized exchanges don't have enough market depth for StETH and ETH trading pair for those who want to sell. Here's the StETH US market depth, and as you can see, it's taking a huge dip. The only way out left for retail investors is the Curve pool, which has been rapidly shrinking by 10 to 15,000 ETH a day this week. Assuming that rate continues, the pool will be fully drained within 2 weeks. We have 2 weeks before that's fully drained. So, not financial advice. My prediction, we will see a huge depegging between Ethereum and staked Ethereum within about 2 weeks. So Friday, 2 weeks from now, we'll go ahead and take a look at it and we'll let you guys know if that little prediction is correct. I'm feeling that it may be. I hope you enjoyed this clip from the Crypto Mining Morning Show every Monday through Friday, 7:45 a.m. Pacific and 10:45 a.m. Eastern Time. You can check out more clips here, or if you're interested in checking out the entire live show, you can check that out down here. Thanks for watching, and I'll see you next Tuesday.